Hey guys, welcome back to Andrew Invest. Today we have some really important news to discuss. Silicon Valley Bank, SVB, has gone bankrupt. It was the 16th largest bank in the US at the time of its failure, and it's the second largest bank to have ever failed in US history. So it's a really big deal. What does this mean for the US economy and the stock market and the global economy? And how did it happen in the first place? So you may have seen some of the headlines surrounding this failure over the last week. And what is happening now is the process of deciding should the government step in and bail out the depositors of this bank, or should they just let it fail and let the free market economy effectively take over? Now, it may not be as cut and dry as you immediately think. So I'm going to present both the arguments for each case today, explain why the bank went bankrupt in the first place, and the consequences of potentially more bank runs happening if this bank is not bailed out by the government. So let's get into it. Let's get straight into it, and I hope you guys enjoy the video. So let's start off with why SVB even collapsed in the first place. So SVB's 44-hour collapse was rooted in treasury bets during the pandemic. Now, you say, why was this a big deal? Treasuries have no risk, right? That's not actually true. Treasuries have no default risk, i.e. the US government will almost always pay back the amount of money that it borrowed in the first place. However, if you borrow from the US government when an interest rate is very low, i.e. let's say you borrowed a 10-year bond when the interest rate was 1%, the Fed Reserve rate may increase significantly during the duration of this bond, i.e. within 2 years, you have 8 years left on that 10-year bond, and the interest rate of cash may be 5% now. That means that your bond has gone down significantly in price so that it matches the current interest rate. So you are effectively underwater. Now, as that bond approaches the time of maturity, i.e. 10 years, it will start to creep back up in value. However, that won't be for a long time. Let's go through some of the numbers so I can demonstrate to you guys what I mean. So SVB's financials here show that its cash significantly went up in 2020 and 2021. It doubled from 2019, and that was most likely just due to the easy money during the pandemic and fiscal stimulus. So what did they do with that money? They then invested it in 10-year treasuries, which had a yield of around 1 to 1.5% during 2020 to 2021. And from what I've heard is that 10-year treasuries is the majority of what they invested in. And if we look at the yield now, it's increased to 4%. Now, we know that prices of bonds move inversely to the yield. So as the yield goes up, price goes down. Let's look at this little Excel sheet that I made here. So here we have the initial investment, let's say $100, although it can be scaled up to whatever you want. The initial interest rate, we're being generous, was 1.5%. So every year you get paid 1.5% interest. Now, that means that after 1 year, when the interest rate increased to 4%, your initial bond had 113.5 left to pay you. That's the sum of all of the coupons remaining plus the principal that you invested. Now, with that new 4% interest rate, if you have $100 of cash, you can now invest it in a 10-year treasury, which is yielding 4%. So the total return of that would be $136. So your bond that you own is only returning 113.5, whereas if you get a new bond, it's returning 136. So how does this make sense? If you want to sell your current bond, you are not going to get $100 back for it. In fact, you are only going to get $77.5 back for it. This is to make up for the fact that investors want to be making $136 total from whatever bond they're buying. So you're effectively underwater by over 20%. Now, if depositors get wind of these losses and decide to withdraw all of their money at the same time. And this usually happens in the case of a bank run, which is what this effectively was. Then you run the risk of going bankrupt. So as we can see here, a frenetic 44 hours in which its long established customer base of tech startups yanked deposits. If you're a business that hears that your bank is in trouble and is potentially going to go bankrupt, you're only going to panic and decide to withdraw more. So now that we know why SVB went bankrupt, what are the consequences of it doing so? So I found this thread on Twitter really useful for understanding the overall figures and what's going on basically. So to give a little bit of context, the FDIC is a federal organization which is in charge of giving depositors money back in the event of a bank failure, effectively organizing all of the numbers, selling out of their investments and returning it to the depositors. This process can take months to years usually. Now, the FDIC has an insurance policy whereby any accounts which are under the value of $250,000 will automatically be paid immediately via the federal insurance mechanism. Now, that would be fine for the vast majority of individuals who hold cash accounts. However, Silicon Valley Bank took deposits from mostly businesses and businesses which put in deposits of significantly more than $250,000. In fact, Circle, which is responsible for USDC crypto coin, had over $3 billion worth of its reserves in this bank and is now at risk of losing it / not getting it back for years potentially. So this isn't the only company. Let's just go through the thread. So over 95% of Silicon Valley Bank's deposits are not insured by the FDIC due to being over $250,000. That's over $160 billion of uninsured deposits. Nearly half of all venture capital funded startups in the US are customers of SVB. That's 65,000 startups. Now, with 65,000 startups potentially being unable to access cash, that could mean that they're unable to pay their employees and forced to go out of business. If 65,000 small businesses go out of business all at the same time, that would have an absolutely huge effect on the US economy. It's hard to understate that. So I think there is a very good case for the government to step in here and prevent the failure of this bank actually affecting its customers. Now, one of the main arguments of people who would not want the government to step in here would be that we live in a capitalist system, and with risks like these, the capitalist system should effectively take control of itself. If you take a risk, then there is a risk of you failing. The taxpayer should not be on the hook for that. Now, that is a good argument, but in this case, is it really such a risk to place your money into a bank? It's not exactly the responsibility of, most people and companies who are depositing money into banks are not going to be taking a complete, an analysis of their bank's finances, right? If you were to put your money into HSBC, you're not going to go and look into every single one of HSBC's investments and its performance and etc., right? You just expect the bank to work. Banks are really opaque as it is, so it's really hard to see this information in the first place. Now, it does look like some dodgy things have happened at SVB. The CEO sold 11% of his stock before the bank collapsed last week. The CFO sold 32% and the CMO sold 28%. Now, all of these people should definitely get into trouble. Every employee who has done anything fraudulently or tried to preempt the collapse of his bank by selling their stock should be prosecuted accordingly. But does that necessarily mean that the customers of the bank should be affected by the failure of the bank and effectively be forced to go out of business? I personally don't think so, and I think there's a strong case to be made for the bailout of this bank. Currently, the government is saying that it's unlikely to step in and do a bailout. However, that was the same back in 2008, when governments were basically very reluctant to bail out the banks, but then they were forced to by the scale of the crisis. So here we have Janet Yellen, the US Treasury Secretary, saying that the government will help SVB depositors, but rules out a full bailout of the bank. Now, it's worth noting that a full bailout isn't necessarily needed, but a guarantee on all depositors' money would definitely go a long way in restoring faith in the financial system. What will happen if there is not a bailout? Not only will the small startups be unable to pay the ones that deposited with SVB be able to pay their employees, there could and most likely will be multiple other bank runs on other banks which are similarly exposed to treasuries and do not have FDIC insurance on the majority of their deposits. So Bill Ackman, the legendary investor himself, said the government has about 48 hours to fix a soon-to-be irreversible mistake. By allowing SVB Financial to fail without protecting all depositors, the world has woken up to what an uninsured deposit is, an unsecured, illiquid claim on a failed bank. Absent JP Morgan, Citi or Bank of America acquiring SVB before the open on Monday, a prospect I believe to be unlikely, or the government guaranteeing all of SVB's deposits, the giant sucking sound you will hear will be the withdrawal of substantially all uninsured deposits from all but the most systemically important banks. So that basically means that all small to mid-sized banks that do not have insured deposits will be facing bankrupts. This could be a crisis on the scale of 2008, and that's not an exaggeration. So what I've also heard, there's already signs of panic starting to set in for the market open on Monday, with US already discussing a fund to backstop the deposits of other banks that fail. So rivals of SVB like First Republic have had their stock tumble by 34% last week. Other banks like Western Alliance Bancorp, a regional rival, has had to point towards its robust liquidity and strong deposits. That's a bad sign in itself. If a bank actually has to reassure investors about its deposits, it's obviously a sign that something is not right. The very fact of them having to do that is not the sign of a normal market. Other banks are dropping significantly, and there is fear that this could spread throughout the banking sector. Now, the fallout of SVB is not even limited to solely the US. SVB had branches in a significant number of other countries, including the UK and even Singapore. And those countries are also facing the tough decision of whether to bail out those branches or risk tech startups all going out of business at the same time. In the UK, it's looking likely that the Chancellor will bail out SVB's UK branch, and other countries are going to have to follow a similar path or risk all of their startups going out of business. So that's not the only risk as well. The trouble with the banking sector could spread to other countries' VCs and banking companies as well. So we're looking at a very difficult situation. I think on Monday, the stock market will be in the red, significantly so, and I think we'll be facing at least a few weeks of pain. And I think, to be honest, it would be a good time to get in, because I do think that the governments will end up bailing out all of these banks and securing and guaranteeing people's deposits, which would mean that there is unnecessary panic in the stock market, which is always when it's the best time to invest. When the market is scared, that's the best time to be greedy. When the market is greedy, that's the best time to be afraid, right? So I'm planning on buying some more stocks within the next few weeks. I will obviously be making videos of that. So I hope you've enjoyed this episode, and I'll see you guys next time.